The purpose of this video is to discuss risk management in detail. It is one of the big four. Every trader who wants to be consistently profitable must master this skill. We are going to discuss a powerful risk management strategy that has helped me pass several prop firm challenges and get consistent payouts. When it comes to risk management, we will discuss the following: an overview of risk management and its importance, the elements of a risk management plan, how pro traders manage risk as well. By the end of this module, you will be able to build your own risk plan or improve the one that you already have to make larger and more consistent profits. Okay, let's jump into it. Now, risk management is one of the big four concepts, one of the concepts that all traders who want to be consistently profitable has to master. Now, the first thing when it comes to risk management is capital preservation. You must protect your own trading account. No matter how much money you have, the market can take all of your money from you. There are people that are trading in the 8 and 9 figures. So there are other people who will be on the other side of the trades and they can wipe out your entire account. So it is on you to manage how much money you're willing to risk per trade. This is very important. So let's give an example. Now, let's say you take a buy from here, anticipating that the market goes up and you have a $100,000 account. Now, the market goes down for whatever reason. If you do not close the trade that you're in, your account will go to negative 50,000, negative 25,000, and continue on as long as your broker doesn't close the position. But theoretically, your money can drain out until you blow the entire $100,000 account. This is a fact. So the market will not control how much money you risk. You are in total control of your account. This is very important to understand. In prop firms, they have risk managers that will watch the drawdown of the traders and close out positions automatically for them to protect their capital. Most of us don't have these types of systems in order, so we have to use proper risk. We have to manage our trades and ensure that we aren't losing too much money. Now, on the flip side though, let's say we enter into a buy here with a $100,000 account. If we enter into a buy and the trade goes in our favor, the market goes in our favor. If no one closes the trade, if I don't close the trade, that trade can end up making 125K, 150K, 175K. And that's what a lot of us dream of. But when it comes to taking your profit, you are in total control as well. And many people don't have a proper system for both taking losses and taking profit. And this is what we're going to discuss in this series. So first off, you are in total control of your own capital. You have to manage your losses. And then on the flip side, you have to manage your wins. Now, I know what some of you are thinking is, how about I just let the trade run? Many of us suffer from this problem. We want to let the trade run too long and not take the profits as the market gives us. If we go back to our premises of the market being random, we will understand that nothing is guaranteed and that we have to fight the thoughts, the emotions, and the feelings of greed, the feelings of wanting more, because the market can easily be on the rise and we can look away and the market can drop in a few minutes and we are negative. This is a fact. This happens to traders all the time. So we have to fight the feelings of euphoria. We have to fight the feelings of certainty, where we think that we know that the market is going to continue up. We have to manage both our losses and our wins. And these are totally in our control. And in this series, we will talk about how to design a plan that we can take advantage of, where we can lose well and we can win very well. Okay. So we want to stay away from this scenario as well. Now, if we go, so the first thing I want to talk about is taking profit. I want you to prepare yourself for taking profit. We're going to define a system for taking profit, but there in our trading platforms, there's what you call a take profit level, or what we call the TP. We want to get used to setting the TP and having clear terms for when we will take profit, where we will take profit. And in our system, I'll share with you exactly where I take profit and how I judge where to take profit, right? So here we enter to a buy. Our balance is at 100K. In our system, our take profit is at 125K because of certain rules that we haven't discussed yet. So in our system, we take a buy here at 100K, and we have in our system certain profit levels where we will set a take profit, set the TP to take us out of the trade or take partial earnings from the trade. This is very important. No matter what happens after, we have to follow our rules, the rules that have proven to be most consistent, because we do not know what will happen after. Price can easily come here to our take profit. We can second guess ourselves, hesitate, or remove the take profit, and price can easily go down into the negative, and we missed out on the money that we could have taken out of the market. So this is very important. We want to have a take profit. On the flip side, we also need to have what is called a stop loss, right? The stop loss is designed to protect our account. So we enter into a buy here at $100,000 and price goes against us, right? Let's say it's at 95K right here. We want to get out of that trade. We want to take ourselves out so that we can preserve our capital, as well as we can take another look at the market to see if we should have been, if we should change our bias, right? So we had a bias of a buy here, and then we were taken out. And if you look, it actually is doing a downtrend movement, creating lower highs, lower low, lower low, lower high, right? So we should be selling now. But what happens is once you're in a position because of emotion and fear and wanting to try to prevent losing, what happens is people normally will stay in this buy position in negative, in drawdown, and they can't think clearly. So as the market is creating lower lows and lower highs in a downtrend, and they should be selling now, they're holding on to a buy because they can't think clearly. They can't think straight. They don't see the market in an objective way. They're holding on to this money, and every little tick upwards, they're thinking that the market is going to go in their favor. It goes down and creates a lower low, which we expect a lower high. We expect an upward movement, but if they're still holding it down here, when they see that upward movement to create the lower high, they're hoping that the market is going to go up so that they can get out of the position. But the market continues in a downtrend movement. So what we want to do is we don't want to marry a trade. We don't want to get into the trade and hold on to that trade and watch our money evaporate from our account. What we want to have in place are stop losses, which we call as an SL. We want to have the stop loss in place to take us out. Go ahead and get out of that trade, lose 1% or so. And then you may want to, you can have a clear mind and you may be able to change your bias, okay? And make that money back or more if you have confirmations for a different position. So now let's look at this in the context of the random distribution that we talked about, the randomness of the market. So if we go back to that heads and tails situation where we talk about how our edge works, right? We don't know what will happen in the market, but through the study of data, we will derive an edge. And our edge is like the loaded heads, the coin, right? Where if it lands on heads, we know for a fact it's always going to land on heads 5 out of 10 times. Okay, we know for a fact that's our proven edge with this particular coin. So if it lands on heads, we make $1,000. If it lands on tails, we lose 500. We already know that this is predetermined. So if we flip the coin 10 times, we'll net $2,500 at the end of the 10 flips, which is good. This is how we make money, by designing a plan where we know what our edge gives us. We have a specified amount that we will lose per trade. Then we have a specified amount that we will take per trade. So we go back, if we look at if we talk about this in the context of our market, in our chart, when we define the take profit, okay, we would define a certain level, okay, and we'll always take that money. That's what our edge, when it comes to our edge, That's what's been proven by data. And then on the other side, we'll define how much we're willing to risk, and that amount should be less than what we are making. So this is how on a 50-50% lands on heads, 50% lands on tails. The heads amount is greater than the tails amount. Our wins are 2 times more than our loss. And this is how we'll come out on top, even with the 50% win rate. This is what we will do for risk management. Number 1, we have to protect our accounts. Number 2, we will manage how much we will lose, as well as how much we're anticipating to gain from the market every time we take a trade. This is very important. Now let's look at what will happen if we take $1,000 from the market, but when it comes to heads is us taking $1,000 win, the tails will be the loss amount. Let's say we don't define a clear stop loss and we start to lose more than we win. So let's say every time it lands on tails, we lose $2,000. If this happens, if we let those losses run and we don't cut them off, what will happen is with the same exact edge that we had, the same exact edge where it lands on heads 5 out of 10 times, the same exact edge that we had before, if we're losing 2,000 every time it lands on tails, then we will net 5,000 at the end of the 10 flip. Same exact trades, same exact edge, poor risk management. So instead of letting the trades run to 2,000 loss, we just let it run to 500 and cut it off. We'll get into this a little bit more in a little bit. So now the last thing we'll discuss in this video is keeping our risk consistent according to our plan. So the beginner trader, their equity, their account looks like this. It goes up, then massively goes down. Okay, so we went up $1,200, and then not only did we lose more than $1,200 here, we lost about $1,500, right? So we lost more than we gained. Now we go all the way back down. We win a little bit, lose a little bit. Win, another massive loss, okay? Just up and down, and it looks very chaotic, very sporadic, okay? Big jumps, big spikes. This is not what we want when it comes to our balance, our equity curve, okay? We don't want the big drops. Here, trader lost $3,100. It made their way up, boom, another big loss, then a big win, then a loss, then a win. These wins are not consistently the same size. So this type of random risk hurts all of the beginner traders. This is one of the challenges that they don't understand, that they can't see, and that it's hard for traders to perceive how damaging it is to their trading, to their accounts. What we want is a consistently rising equity curve. And when you take the FTMO challenge or another prop firm challenge, when they do the analysis, they're going to test you on hitting the 10% target, right? To be able to hit that 10% target, you have to have a rising equity curve, okay? Your equity has to be rising slowly. To hit the verification, you have to be rising again. And then to get funded, it's the same. So what I'm going to teach you in the risk management module here is how to have a rising equity curve like this, where the wins are bigger than the losses. So you take a win here, loss is smaller. Next time you win, it's bigger. The loss is smaller than that win. Next time you win, it's bigger. You take a loss, or maybe take another loss, 2 losses, but 1 win will take care of 2 losses. So every time you win, you should have a spike. When you lose, it should be a smaller amount, a smaller decline in your series. So in the next video, right after this, we're going to get into risk to reward, which is very important, but most traders don't really understand its importance. So see you in the next video.